Hey gang, Carl White here, broadcasting here in the thinking room
Ooh, I like it.
of the secret headquarters here at the Mortgage Marketing Animals. My name is Carl White. I'm here with one of my partners,
Kristin Simpson.
and you are on the right episode if you want some good news. We just heard some good news, and we thought we'd share it with you. So we're in a little private mastermind meeting here, actually at my house.
Mhm.
And so there's about, I don't know, 15 of us, I guess, something like that, doing what we call a garage fest.
I
And
like it.
so, the garage, so we're literally in my garage. It's a nice garage.
Oh, it's gorgeous. You wouldn't know it's a garage.
Yeah. So it's, I think it's 1,800 square feet, by the way.
You've got those nice floors. What are they called?
Nice floors.
Nice floors.
That's what you call it. And, the thing about garages are like closets. Whatever you have, you'll fill it up, right? So,
Mm.
but anyway, so we moved all of Maria's car toys out of the garage, and we're meeting in there and going over some good stuff. But the good news that we heard is that this is the year of the fives, the year of the fives. So there's three great pieces of news for us in the mortgage industry. And so the year of the fives, three things. Number one, it's predicted that rates are going to go back into the fives.
Woohoo.
So that's
exciting news.
That's good.
Mhm.
Back when they were twos, fives seemed high, but having been scratching the eights for a little while earlier, late toward last year, getting back into fives. You know what that's going to do, Kristen? It's going to do two things. Number one, it's going to boost the purchase volume again.
Oh, yeah.
Because there was some great appreciation the last couple of years, and I think that kind of scared people off a little bit.
Mhm.
But now it's become the new norm. That this is what it costs now, and everybody knows. Well, gee, if I have to wait, until the prices of houses go down, that historically doesn't happen, right? Are very rare. And so I think they've been reset with the new price. And the fives, while going from the two seems high, but coming from the eights seem like, wow, it's a great time to take action.
Exactly.
And so I think it's a really, really going to be a really good time, because not only are we going to have the purchase market, but there's a fair amount of loans that were in the eights, certainly the high sevens, that now that they're heading toward the fives, we're back into refinance opportunity.
Mhm.
You know what and we're going to talk about the other two here. The problem with going back in the refis though is I did this survey 2 weeks ago. What did you learn the last 2 years? What did you learn, and what are you going to do because of what you learned? And a lot of people said, well, I focused on the refis and I stopped my purchase marketing.
Oh, yes.
And we're going to have to be really careful not to fall into that trap again, or the same thing will happen. We'll have another roller coaster.
Right.
Except instead of a roller coaster being up a month, down a month, it's up a year, maybe down 2 years.
Yes.
Kind of thing. So I think we're going to have to really guard ourselves that, how do we capitalize on the refi market while without sacrificing our purchase marketing?
Can I ask you a question on that?
I'd love to hear it.
Okay, so I know that in your branch, you kind of have a ratio that you like to balance
Yeah.
too. So is that really being focused on keeping track of that?
It is. So that's never stopped. So great question. So the ratio in our office, and we stay pretty good to it, right? We stay pretty good to it.
Even when the refis were?
Even. Let me tell you how. So the ratio is 70-30. So 70% purchase, 30% refi.
Right.
So we've always focused on that. That's been very profitable for us to do. So here's the side effect of it. And what happens when we do that is we always see growth. And how we always see that growth is, like, let's say the refis are booming in.
Okay.
And you go, okay, I'm not at 70-30 anymore. I'm at 60-40. I'm 60% purchase and 40% refi, or worse, I'm at 50% purchase and 50% refi, or God knows, forbid if it actually, if it reverses, and I'm 80% refi and 20% purchase, right? So what happens is, as soon as we see that we're, say, 60-40 and our refis are, I'm not going to say too high, it's our purchases are too low.
Okay.
And so we don't stop working on our refi marketing, but we double down on our purchase marketing.
Mm-hmm.
And the mistake that most people make is they double down on the one that's good,
Yeah.
which will give you a good this month. But then the last 2 years has been real skinny for a lot of loan officers because they doubled down on the refi marketing
Right.
while they held off on the purchase because the refi was so easy. They thought, well, I need to get this while the getting is good. But then they paid the price the last 2 years. Any gains that they likely made during the refi boom,
Yeah.
they probably lost all those gains,
Mm-hmm.
the last couple of years. And the problem with a lot of loan officers is they spent that money already. And so then when they have this downtick, a lot of them have, it's a tragedy to see them bailed out of the business because they simply didn't market on keeping their business at 730. So just like here recently, in the last year or so, keeping that 70-30 has been a challenge. In other words, keeping that refi at a 30, even though there's great opportunity with all the debt consolidation.
Mm-hmm.
We've seen these records and charts, where consumer debt is like the highest ever credit card debt.
It's over $1 trillion.
It's enormous, right? It's bigger. And if you look at the chart, it looks like a hockey stick. I mean, it's rampantly out of control, I think, and could be into trouble. But so as our purchases went toward 80-20, 80% purchase, 20% refi, or 90-10, we kept doing our purchase marketing, but we doubled down on our refinance efforts to get that back to 30. So in other words, we don't decrease our purchase.
Right.
We keep that at a high level. We just raise the refi even more. And then let's say we're at 70-30 and we end up at 65-35. We don't stop our purchase. We keep that at that new high level. We just double down on the purchase and get that even higher still. Mm-hmm. And what happens is you get this stair stepping of it continuing upgrading. So we've kept pretty close to that. I saw, I know I talk about her all the time because she's an awesome person. I saw Tammy Saul sent me her numbers over the other day. And I don't remember the exact number. It was like 80 closings for the month or something like that. But if I remember right, she was like, and again, this is just off the top of my head.
Right.
I think she was like 49 purchases for the month as a single loan officer, right? And I think it was like 30 or 35 refis.
Okay.
And so she approaches like 60-40, mm-hmm. And so she's kicking my butt. Right.
Kicking everybody's butt.
Yeah. And that she's really able to help out a lot of families on the debt consolidation stuff. Mm-hmm. And because it's so tempting that, I'm not going to focus on the refi stuff because I'm using air quotes here, too hard. Yeah. And I'm just going to keep doing the purchase stuff, but you're losing a lot of money. So that 70-30 is a really big deal.
And do you look at that monthly?
Absolutely.
Every month.
Absolutely. Gotcha. Okay. Because like in a football team, you're looking at the scoreboard often. Yeah. Because if you don't look at the scoreboard, you can fall behind, mm-hmm. and that's when you get into trouble. So yeah, we're looking at that like all the time. Just like a race car, they're measuring every lap. They don't measure every 20th lap, because if they start to see a trend, they want to fix it like right then.
Right.
So you don't want to fall behind on this stuff. So the rule of fives, interest rates are predicted to go into the fives. So this can be a really good time for us. So those of you that's been hanging in there, I would just encourage you. Chris and I just would encourage you, keep hanging. Like don't give up yet, and double down on your marketing and make sure that you're doing your prospecting, and make sure you're prospecting to the right people with the right message. And I'm telling you, it's going to be a really good year. I really and I'm kind of an upbeat, positive person anyway. But I think the indicators of it being a great year, it's not just positive thinking. I think it really is going to be I think it's going to be a really, really good year. I really believe that. So the second part of the rule fives is
5 million homes.
They're expecting 5 million homes to be bought here this year. So, which again, a very robust purchase market. And so, because one thing about any kind of demand, anytime you have a slow up on the results, so anytime you dam up the river, the water's still coming in. It's just being held back by the dam. And so people's desire to move didn't stop.
Mm-mm.
It was just a roadblock, a dam put in place, interest rates, the shock of the increase of homes, the economy, not sure, inflation, is my job okay? Am I going to get laid off?
Right.
So people kind of hunkered down a little bit, but that desire continued to build. And what you're seeing now is, I'm not going to say the dam has broken, which would be a good thing for us. But I think the dam level has decreased a little bit, and the water is going to be spilling over a little bit,
Yeah.
and a lot of people are going to be taking action. And it is a great time, and maybe the best in my mortgage career. It's a great time to increase market share.
Mm.
So that's what I'd be thinking right now is how do I maybe not even how do I get back to 2020 levels, right? Like
Okay.
whatever. And that's a good thing. But even more importantly, how do I increase my market share right now? How do I get more referral partners? How do I get more sources of referrals? How do I get more leads coming in from different areas, like increasing my market share? I think that it's never been easier because there's so much less competition. Most people, most loan officers are going to be, quote, hunkered down
Mm-hmm.
and kind of curled up in a fetal position, still sucking their thumb and maybe seeing the light of day and maybe seeing a little bit of relief, but they're still afraid to go out and make things happen,
Right.
because they're a little post-traumatic stress syndrome kind of thing. They're still hunkered down. So increasing market share right now is absolutely critical. I'm telling you, the people that actually take action will find it's never been easier to create market share right now. So 5 million homes, that's a lot of homes.
Yeah. It's a great time to have conversations.
It's a great time to be having conversations. Rule of the year of the fives, number 3. So the first one,
Rates in the fives.
the second one,
5 million homes
sold. Yep.
sold.
And the third one is they're expecting nationwide appreciation to be about 5%.
Mm.
So it might not be the 20 and 25% we saw for a little bit, but I think this past year, 2023 was slightly less than 5 for most of the country. Some areas not, but most of the country is flat-ish.
Mm-hmm.
And I think they're predicting that appreciation is going to start to pick up a little bit. And what that means is it's easier to have conversations with people about buying homes. And even though the rates might not be in the 2s, they're in the 6s for sure right now.
Right.
And for most of us in most situations, they're in the 6s, give or take. And Mr. and Mrs. Homebuyer, it's a good time to be buying right now because next year this $300,000 house would cost you 5% more.
Right. And you have 5% equity in it.
And you'll have 5% equity in it. So it'll be easier to have those conversations and lead them into a positive direction because it'll be the right thing for them to do. Because otherwise, they're going to pay more, not less, for the house, the following year. So the year of the fives, I think it's going to be a good year.
I love that.
Yeah. So if I want to increase market share, what do I do? And I think that's the conversation that you have with people, isn't it?
Mm-hmm.
Yeah.
It is.
So look, we're not going to stretch this episode because we got another topic we're going to shoot on the next episode here. But I think the main message that we want you to get today is now is the time. Now is the time to come out of the bomb bunker. The air, the radiation is cleared, right? And it's a really, really, really good time. And we really want you guys to be focused on increasing your market share. I promise you that you do the work now, and a year from now, you'll want to come back and kiss yourself on the lips for putting yourself in the position that you'll be in a year from now. Not that it'll take a year to do it,
Mm-hmm.
but because what we're seeing and in this mastermind meeting that we're having is people are seeing results like right away.
Yeah.
Because most people aren't taking action. Most people are still kind of hunkered down and making sure the air is clear. It's time to come out of the shelter, time to come out of the closet, time to get to work. And it's never been a better time to do that. So if somebody wants to have a conversation with you, Kristin, where we map out the exact activities to do to increase market share and just kind of brainstorm back and forth with each other, if they just go to freedomclubdemo.com, freedomclubdemo.com, that we promise you, our promise to you is we'll give you a full 45 minutes. This is a one-on-one call, and you'll be teamed up with a brilliant mind that all you do all day long is talk to loan officers all across the nation, hearing their best ideas, and then share those ideas to me for me to put into my team, and then share those ideas back to the loan officers when you talk to the second call. Because what you learn from loan officer on call number 1, 2, and 3, you share with loan officer on call 4, 5, and 6. So what do you think is what's typically the biggest breakthrough? Like when you're on these calls with somebody, what are some of the bigger ahas that you get out of these sometimes, where something that might seem kind of simple and you go, well, have you thought about this? That what have you seen moves the needle most for? Better way of asking.
Well, I think it depends on where they're at in their business, right? But what I try to do on these calls is, it's one thing to say, okay, I got a prospect, or I have to have a plan to come out of the closet and come out and start doing stuff. What is exactly that plan? Who am I calling? Who am I talking to? What am I saying? How does that actually get me business? And when we dig into some of the conversion numbers, that's often the biggest aha moment,
Tell me about that.
Well, specifically with databases, we know that when you look at a database, we expect about a 1% conversion every month out of that database in closed loans.
So what does it mean? So I got 300 people in my database. What does that mean?
That means if we take the right approach to it and we're having the right conversations and we're doing the right activities, we should be seeing 3 closings every month out of that database.
So if I'm making $3,000 per closing, that'd be an extra $9,000 a month.
Exactly. So when we dig into those numbers sometimes, and people take a look at that and they say, am I seeing those closings? Am I seeing that conversion out of the database? If I'm not, yeah, that's a huge opportunity area. Let's talk about it.
Do you find, like I find the thing that holds most loan officers back and they end up investing in a bunch of widgets is call reluctance, the fear of having conversations. Do you find that when they know what to say and they're saying it to the right people, do you find that gives them the confidence to actually start making the calls in?
Oh, 100%. And if they are making the calls, if they're not having the right conversation, if they're not having the right questions or the right call to action, they're not going to see that conversion out of it. So oftentimes it's just tweaking what's being said.
That's what I find, because like I have zero, like here, I'll give you an example. Let's say I've got the winning numbers to tonight's lottery ticket, right? And I know somehow I got it, and ethically, right? So that's the way we do things, but somehow ethically I got the winning numbers. And now I'm calling strangers out of the blue and giving them the winning numbers. Or I'm calling, here, we'll do it this way. I'm calling high producing real estate agents in my area. We always talk about, what's that thing of value you're bringing? I'm bringing the winning lottery number ticket, right? I'll be their new best friend, right? I would have zero call reluctance if I know for a fact that I'm calling them up with the winning lottery number. I think we can all agree that none of us would have call reluctance making that call.
Right.
So it's only when we don't know what to say or how that conversation goes, when we eliminate that piece of it and we're having the conversations to the right people, call reluctance really just goes by the wayside. It's an issue of, I'm not sure what to say.
Exactly.
So, cool.
Exactly.
freedomclubdemo.com, freedomclubdemo.com. Would love to talk to you. Hang in there. We appreciate y'all letting us be part of your world today. And I'm Carl White.
I'm Kristin Simpson.
And we'll see you on the next episode of Loan Officer Freedom. Thanks again, everybody. Bye-bye.